Hello everyone and welcome to my channel. Compliance Lookup. In today's video we will be discuss an important topics MLCFT legislation in major countries region. In the earlier chapter, we learned international guidelines and standards. If you have not watched then please watch lecture 4 of this playlist. These topics are essential for financial security and in future videos we will dive deeper into how these procedures are implemented, the tools used and the real world impact they have on businesses and individuals. If you found this video helpful, don't forget to like, share and subscribe for more content on financial compliance, regulations and more. Our first topic is AML legislation at national level. Most countries have laws against money laundering and terrorist financing. These laws require financial institutions to report suspicious activity, know their customers, and keep records. There are also agencies that oversee compliance and investigate violations. Countries cooperate internationally to combat these crimes. Now, coming to Council of Europe Convention CE. This is a significant international organization that focuses on promoting human rights, democracy, and the rule of law in Europe. One of its core concerns is combating money laundering AML and terrorist financing CFT through legislative and enforcement measures. Over time, the Council of Europe has developed several conventions that directly deal with AML CFT. Now coming to out key Council of Europe conventions on AML CFT. European Convention on the Suppression of Terrorism 1997. The European Convention on the Suppression of Terrorism 1997 is a treaty developed by the Council of Europe to strengthen the fight against terrorism in Europe. It aims to make it harder for terrorists to carry out attacks and find safe havens across borders by enhancing international cooperation and legal frameworks. The convention focuses on criminalizing terrorist acts, improving extradition procedures, and promoting mutual legal assistance between member countries. Key provisions of the convention. 1. Criminalization of terrorism. The convention defines certain acts as terrorist offenses, including the use of violence or threats to instill fear and influence governments or international organizations. It acts like attacks on the public, kidnapping, bombings, and threats to public safety are explicitly considered terrorism under this convention. Example, if a terrorist group in one country uses violence to disrupt a political event in another country, the action would be considered terrorism under this convention and the responsible individuals could be prosecuted. 2. Extradition for terrorist offenses. Countries that ratify the convention agree to extradite individuals involved in terrorist activities to face trial in the country where the offense occurred. This provision ensures that terrorists cannot escape prosecution by crossing borders. Example, if a person involved in a terrorist plot in Italy is found in Spain, Spain would be required to extradite that individual to Italy to stand trial for their actions. 3. Mutual legal assistance. The convention also promotes legal cooperation between member states, ensuring that evidence, documents, and testimony can be shared more efficiently for investigations and trials. This helps countries work together in prosecuting terrorism related offenses. Example, if a French police investigation uncovers a terrorist cell operating in Germany, French authorities can request legal assistance from Germany to gather evidence and prosecute the suspects involved. 4. Prohibition on political offense exemption. Many countries have an exemption for political offenses in their extradition laws, which allows criminals to avoid extradition by claiming that their crime was politically motivated. The convention removes this exemption for terrorist offenses, making it easier to extradite suspects involved in terrorism, even if they claim the act was politically motivated. Example, a person involved in a bombing attack that targets civilians might try to avoid extradition by claiming it was for a political cause. Under this convention, such a defense is not acceptable and extradition can still take place. The European Convention on the Suppression of Terrorism 1997 enhances cooperation between European countries in fighting terrorism by criminalizing terrorist acts, improving extradition procedures, and facilitating mutual legal assistance. This framework helps make Europe a less hospitable environment for terrorist activities, ensuring that those involved in terrorism are prosecuted, regardless of the country they flee to. Now, coming to next, European Convention on Laundering, Search, Seizure and Confiscation of the Proceeds from Crime 1993. It was adopted in 1993 by the Council of Europe. The treaty aims to improve cooperation among European countries to prevent and combat money laundering, especially the proceeds of crime. It provides a legal framework for searching, seizing, and confiscating assets obtained from criminal activities, such as drug trafficking, corruption, and organized crime. Key provisions of the Convention. 1. Laundering of proceeds from crime. In this convention, requires countries to criminalize the act of money laundering, which involves disguising the origins of illegal money to make it appear legal. It establishes that countries should ensure that those who are caught laundering money face criminal prosecution. Example, if someone illegally obtains money through drug trafficking and tries to disguise it by transferring it to a business account, this act of money laundering must be prosecuted under the convention. 2. Search and seizure of criminal proceeds. In this treaty allows countries to search properties and seize assets, money, goods or property obtained from criminal activities. This provision helps to track and prevent criminals from hiding the proceeds of their illegal activities. Example, if a criminal organization in Italy is found to have earned money through fraud and has hidden the proceeds in a bank account in Spain, Spanish authorities can help seize the assets. 3. Confiscation of criminal proceeds. The convention also focuses on the confiscation of criminal proceeds. This means that the assets or money obtained from crime can be permanently taken by the state. Confiscation is crucial to preventing criminals from benefiting from their illegal activities. Example, if a person is convicted of human trafficking in Germany and their assets, such as luxury cars or properties, are linked to the crime, these assets can be confiscated and used to compensate the victims or used for other legal purposes. 4. International cooperation. One of the main goals of the convention is to enhance international cooperation between countries in preventing money laundering and dealing with the proceeds of crime. Countries agree to share information, assist each other in investigations, and help enforce laws related to money laundering. Example, if a criminal group is laundering money across multiple European countries such as France, Spain, and the UK, the authorities from these countries must work together to track, freeze, and eventually confiscate the illicit funds. Example of practical application. Imagine a criminal group in Germany that has earned a large sum of money through illegal drug trade. The group tries to launder this money by purchasing luxury goods and transferring funds to bank accounts in Switzerland. 1. Search and seizure authorities in Germany receive information about the illicit activities and begin investigating. They request cooperation from Swiss authorities to seize the funds in the Swiss bank account. 2. Confiscation. Once the criminal group is convicted, the confiscation process begins and the assets, bank funds, luxury goods are permanently taken by the government. 3. International cooperation. Germany, Switzerland, and other affected countries cooperate closely under the framework of the convention to ensure that the criminal proceeds are returned to lawful use and that the criminals cannot benefit from their illegal gains. Conclusion: the European Convention on Laundering, Search, Seizure, and Confiscation of the Proceeds from Crime 1993 is a key instrument in the fight against money laundering and the misuse of criminal proceeds in Europe. By criminalizing money laundering, allowing for the seizure and confiscation of illegal assets, and enhancing international cooperation, it helps ensure that criminals cannot benefit from their illegal actions. Through this cooperation, European countries work together to trace, seize, and remove illicit wealth from the hands of criminals. Now, coming to our next topic: US. The United States has enacted several important pieces of legislation aimed at combating money laundering, financial crimes, and terrorism financing. Below is a breakdown of the major laws, including their key provisions and practical examples. 1. Bank Secrecy Act BSA of 1970. The Bank Secrecy Act BSA, also known as the Currency and Foreign Transactions Reporting Act, was designed to combat money laundering, fraud, and other financial crimes by require institutions to maintain records of certain financial transactions and report suspicious activities. Financial institutions must file suspicious activity reports (SARs) if they detect suspicious transactions, and currency transaction reports (CTRs) for transactions over $10,000. Institutions must keep detailed records of transactions, including the identification of customers. Financial institutions are required to implement internal AML programs. Example: a bank in the US detects a series of large cash deposits that seem unrelated to the customer's business activities. The bank files a SAR which helps authorities investigate potential money laundering activities. 2. Money Laundering Control Act of 1986. This law criminalizes the act of money laundering and helps prevent financial crimes by making it illegal to engage in financial transactions designed to conceal or disguise the origin of criminally derived money. It makes it a criminal offense to engage in money laundering, regardless of the underlying criminal activity, e.g., drug trafficking, fraud. Provides for severe penalties, including long prison sentences and large fines for those convicted of money laundering. Applies to various sectors, including banks, real estate, and casinos. Example: a person uses areas of shell companies to hide money from a drug trafficking operation. Under the Money Laundering Control Act, these actions are criminalized and the person faces legal consequences. 3. Anti-Abuse Act of 1998. The Anti-Abuse Act was introduced to address the potential abuse of the financial system and prevent money laundering by making it more difficult to use certain financial mechanisms for illicit activities. The Act enhances the requirements for financial institutions to provide information and reports related to suspicious financial transactions. Financial institutions are required to conduct enhanced due diligence to avoid being exploited for criminal activities. Example: a foreign bank tries to open a US branch and transfers large sums of money. The bank is required to conduct enhanced due diligence under the Anti-Abuse Act to ensure that the money is not being laundered. 4. Anunzio Valley Anti-Money Laundering Act of 1992. This act expanded the scope of the BSA and introduced additional measures to combat money laundering. It was a major step in strengthening the regulatory framework for AML efforts. Financial institutions were required to report large transactions and suspicious activities to the authorities more efficiently. The Act included provisions related to international money laundering and gave authorities more tools to cooperate with foreign governments. Example: AUS bank detects large international wire transfers to a country known for money laundering activities. Under the Anunzio Valley Act, the bank reports the activity to authorities, enabling international cooperation. 5. Money Laundering Suppression Act of 1994. This act sought to strengthen the BSA further and improve efforts to combat money laundering and financial crime through better enforcement and more rigorous reporting. Its key provisions. First, increased focus on criminal proceeds. Financial institutions were required to maintain stronger records and identify potentially criminal transactions more effectively. Second, cooperation between agencies. The Act emphasized the need for cooperation between regulatory agencies, law enforcement, and financial institutions in identifying and preventing money laundering. Example: a financial institution receives a series of small, structured deposits designed to evade reporting thresholds. The institution must report these suspicious activities to regulatory authorities as required by the Money Laundering Suppression Act. 6. Money Laundering and Financial Crimes Strategy Act of 1998. This act established a strategic framework for the US government to address money laundering and financial crimes more effectively, combining both national security and financial crime prevention. Its key provisions. First, comprehensive financial crime strategy. The Act created a comprehensive strategy to combat money laundering and financial crimes. Second, strengthened law enforcement tools. The Act provided law enforcement agencies with the authority to use advanced techniques for investigating financial crimes. Example: authorities receive intelligence that a criminal syndicate is laundering money through the US financial system. The Act provides the necessary tools for law enforcement to investigate and dismantle the syndicate. 7. Uniting and strengthening America by providing appropriate tools required to intercept and obstruct terrorism. Act use a Patriot Act of 2001. Enacted after the 9/11 attacks, the Patriot Act strengthened the US government's ability to combat terrorism and terrorism financing, including provisions for money laundering. Its key provisions. First, enhanced KYC. Financial institutions must adopt stringent Know Your Customer KYC procedures, including verifying the identity of customers and screening them for terrorism links. Second, information sharing. Financial institutions must cooperate with government agencies, sharing information to prevent terrorism financing. Second, terrorism financing criminalization. The Act criminalizes financing of terrorism and requires institutions to report suspicious activity related to terrorism financing. Example: a financial institution detects a series of wire transfers to an individual with suspected links to a terrorist group. Under the Patriot Act, the institution is required to report this suspicious activity and cooperate with authorities. 8. Intelligence Reform and Terrorism Prevention Act of 2004. This act reformed intelligence structures and provided further tools to prevent terrorism and combat the financing of terrorism. Its key provisions. First, enhanced intelligence sharing. The Act enhanced information sharing capabilities among federal agencies, financial institutions, and international counterparts to prevent terrorism and financial crimes. Terrorist financing measures. Strengthen provisions for detecting and disrupting terrorist financing through financial systems. Example: US intelligence agencies track suspicious financial transactions tied to a terrorist cell. The Act allows agencies to share this information with financial institutions, enabling them to freeze assets or block financial transactions related to terrorism financing. In conclusion, the US has a comprehensive legislative framework to combat money laundering and terrorism financing, with key laws like the Bank Secrecy Act (BSA), USA Patriot Act, and Money Laundering Suppression Act. These laws provide robust tools for financial institutions, law enforcement, and intelligence agencies to detect, prevent, and punish financial crimes, ensuring a safe and secure financial system. Now, coming to the UK part. The Proceeds of Crime Act 2002 POC, amended by the Crime and Courts Act 2013 and the Serious Crime Act 2015. It is a key piece of legislation aimed at tackling money laundering and confiscating assets derived from criminal activity. The Act criminalizes money laundering, introduces procedures for the recovery of criminal assets, and makes it illegal to conceal, disguise, or transfer the proceeds of crime. Key provisions. First, money laundering offenses. POCA defines money laundering and creates criminal offenses for those who acquire, possess, or use criminal proceeds. Second, confiscation orders. Courts can order the confiscation of assets from those convicted of crimes, ensuring criminals do not benefit from their illegal activities. Third, civil recovery. The Act allows authorities to apply for civil recovery orders to seize assets without requiring a criminal conviction. Third, compliance for financial institutions. Financial institutions must report suspicious transactions and have systems to detect and prevent money laundering. Example: a business owner is found to have large unexplained assets after being convicted for fraud. Under POCA, authorities can seek a confiscation order to seize these assets. If the individual cannot explain the legitimate source of the funds, the assets are forfeited to the state. Its amendments. First, Crime and Courts Act 2013 strengthened asset recovery measures and increased penalties for non-compliance. Second, Serious Crime Act 2015 introduced new powers to tackle organized crime groups by facilitating the seizure of assets linked to crime. 2. The Money Laundering Regulations 2007. The Money Laundering Regulations 2007 were designed to implement the European Union's third Money Laundering Directive into UK law. The regulations impose stringent obligations on financial and non financial businesses to prevent money laundering and terrorist financing. Its key provisions. First, Customer Due Diligence (CDD). Businesses must carry out thorough checks on customers to ensure that they are not involved in money laundering or terrorism financing activities. Second, risk based approach. Firms are required to assess the risks associated with their customers and tailor their procedures accordingly. Third, reporting obligations. Businesses must report any suspicious activity or transactions to the National Crime Agency (NCNCI). Fourth, training and compliance. Businesses must train their employees to recognize and deal with suspicious activities. Fifth, record keeping. Firms must keep records of customer identification, transactions, and reports of suspicious activity. Example: a real estate agent receives a request to purchase property using large sums of cash. The agent conducts CDD and finds that the buyer has a complex structure of offshore companies, which triggers the requirement to file a suspicious activity report (SAR) to the NCR. 3. The Terrorism Act 2000. The Terrorism Act 2000 provides a comprehensive framework for the UK to combat terrorism and the financing of terrorism. It defines terrorist offences and introduces powers to stop and search individuals, seize assets, and combat the financing of terrorism. Its key provisions. First, terrorist financing. The Act makes it a criminal offence to fund terrorism, whether by direct or indirect means. Second, asset freezing. The government has the power to freeze assets related to terrorism to prevent funds from being used for terrorist activities. Third, terrorist property offences. Possessing, handling, or dealing with terrorist property, including money, is illegal. Fourth, reporting obligations. Businesses and financial institutions must report any suspicion of terrorist financing to the authorities. Example: a bank detects a series of wire transfers to an individual suspected of having links to a terrorist organization. Under the Terrorism Act 2000, the bank must report this suspicious activity, and the authorities may freeze the individual's assets to prevent terrorism funding. 4. Money Laundering, Terrorist Financing, and Transfer of Funds Regulations 2017. The Money Laundering, Terrorist Financing, and Transfer of Funds Regulations 2017 implement the EU's fourth Anti-Money Laundering Directive into UK law. These regulations provide a detailed framework for the prevention of money laundering and terrorist financing. Its key provisions. First, enhanced due diligence AD. Firms must carry out more extensive checks when they suspect a customer is at higher risk for money laundering or terrorist financing. Second, beneficial ownership registers. Financial institutions and other regulated entities must collect and verify information about the beneficial owners of companies and trusts. Third, transaction monitoring. Firms are required to have systems in place to detect and monitor suspicious transactions. Fourth, cross border transfer of funds. Regulations require that transfers of funds between countries are accompanied by accurate and complete information about the sender and recipient. Example: a payment service provider receives a transfer from a customer located in a high risk jurisdiction. The service provider is required to conduct enhanced due diligence and verify the source of the funds to ensure they are not related to money laundering or terrorism financing. Conclusion: these UK laws and regulations work together to establish a comprehensive framework to prevent money laundering, terrorist financing, and the abuse of the financial system. They require businesses and financial institutions to implement strict compliance measures, including due diligence, reporting suspicious activities, and maintaining detailed records. By doing so, the UK ensures that criminals and terrorists cannot easily exploit the financial system for illegal activities. Now coming to last topic, it's of Australia. 1. Anti-Money Laundering and Counter-Terrorism Financing Act 2006 MLC PA CFF Act. The MLCTF Act mandates businesses such as banks, casinos, and financial institutions too. Its key principle is: first, verify customers. This means checking the identity of customers before providing services. Second, report suspicious activities. Businesses must notify authorities, e.g., OSTRAC, if they detect unusual or suspicious financial activity. Third, maintain AML programs. Businesses need to have internal systems to detect, prevent, and report money laundering and terrorism financing. Example: a bank notices an account holder making large, unexplained cash deposits into their account. The bank suspects that the funds may come from illegal activities. As per the MLCTF Act, the bank files a suspicious matter report SMR to AUSTRAC for further investigation. 2. Australian Transaction Reports and Analysis Centre AUSTRAC. AUSTRAC is the Australian government's financial intelligence unit responsible for monitoring financial transactions and ensuring that businesses comply with MLCTF laws. AUSTRAC analyzes suspicious transactions, collects data, and works with law enforcement to investigate crimes such as money laundering and terrorism financing. Example: a payment provider notices a series of high value international wire transfers from Australia to countries known for terrorism activities. The provider reports these transactions to AUSTRAC, which works with law enforcement to trace the origin of the funds and investigate whether they are linked to terrorist financing. The Criminal Code Act criminalizes money laundering and terrorism financing. It makes it an offense to engage in financial transactions intended to disguise or conceal the origin of illicit funds or to finance terrorist activities. Example: a person transfers funds to a terrorist organization in Syria. Under the Criminal Code Act, this act of financing terrorism is a criminal offense and law enforcement can arrest and prosecute the individual. 4. Australian sanctions and export controls. This legislation ensures compliance with international sanctions, allowing the government to freeze assets or prevent financial transactions that may be linked to sanctioned individuals, entities, or countries. It also controls the export of goods that could be used for illegal activities. Example: a bank detects that an individual's account is associated with a sanctioned individual suspected of terrorism activities. Under the Australian sanctions and export controls regulations, the bank freezes the individual's account and reports it to Austrac. 5. Proceeds of Crime Act 2002. This act provides powers for authorities to seize assets linked to criminal activities even without a criminal conviction. It is part of efforts to prevent criminals from benefiting from their illegal activities. Example: a drug dealer is found to have purchased a luxury car using funds from illegal activities. Even if the person is not convicted, authorities can seize the car under the Proceeds of Crime Act 2002 to ensure that the criminal does not benefit from the illicit proceeds. 6. Australian Financial Intelligence Unit (AUSTRAC). AUSTRAC collects and analyzes financial data to identify suspicious financial activities. It shares this information with law enforcement and regulatory bodies to detect and prevent money laundering and terrorism financing. Example: a financial institution notices several transactions from a customer in a high risk jurisdiction with no clear economic purpose. The institution reports this to Austrac, which further investigates whether these funds are being used for criminal activities, such as terrorism financing. So, we have completed this chapter of anti money laundering and combating the financial terrorism legislation in major countries and region. In the next, chapter 6, we will learn about anti money laundering and combating the financial terrorism legislation in India. Thank you so much for watching this video.